Hello, welcome back. In this session, we are going to cover three important aspects of the technical analysis. So, one of them is moving averages, second is RSI, and third is MACD. And we are not going to talk about the calculations, how these indicators are calculated. There is no relevance of that. But yes, from the understanding perspective, you can just have small understanding around what are these indicators and how they are calculated. So, from the calculation perspective, you can just go onto the Google and just search like how they are calculated, and it should not take more than 5 minutes for you. So now let's talk about the practical aspects of moving averages, RSIs and MACD. So suppose I am talking about 9-day moving average. Here I have taken the 9-day moving average. That simply means that for the past 9 days there was some open and close price, right? So moving average can be calculated based on open price or close price. So now for last 9 days, suppose there was some price. On the 10th day, we will be having an average of all those prices, and then that will become our moving average. For next day, for the next particular day, the previous 9 days will be taken for the calculation of average price. Then it will become for that day. So for any particular day, suppose I'm talking about 9 moving averages. So there will be data which will be collected for 9 previous days, and then the average of those prices will be calculated, and that will become its moving average on the 10th day. So that's how it is calculated. So now we will see how the moving average is being used by the traders. So don't look at this chart, don't look at this chart. These are different. One is MACD and other is RSI. We are talking about moving averages. So moving average, what does it do? It reduces noise from the market. So suppose you look at the market at this point of time, you might be confused whether the market is in uptrend or market is in downtrend. But look at this point of time again, only the candles. Can you understand whether the market is going up or down? From this point, you might think market is going up, right? This point also, you might think that market is going up, right? But if you look at the moving average line, so this is the moving average line. So this is 9 days moving average. If you look at this line at this point of time, it is pretty flat. That means market is not going up. It is kind of in a flat trajectory. So that means it is not going up. So moving average line is reducing the noise from the market. When I say noise, that means on daily basis, candles are making high lows and everywhere they are moving. But moving average will have reduced noise. It will provide you the kind of trend. And if you reduce the timing of moving average, it will become more volatile. But if you increase the timing of moving average, it will become, suppose I put it 50, then it will become even more smooth, because now it is calculating the average of past 50 days. So now you can see longer term trend for this market is going higher, and here the more longer term trend is going lower. So that's how moving averages help you out in identifying the overall trend of the market. Are you in the stock markets but still guessing your next move? I am from Uncover Markets, and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Now there are two kind of moving averages. One is SMA and one is EMA. So EMA is a faster moving average. So that means that the price for the previous day will be providing a little bit more weightage than the price of previous 9 days. So you can use SMA or EMA, any which ways, wherever you get the comfort, you use that particular moving average. It does not matter much. People will be providing lots of theories about it, but when you talk about practical applicability, any kind of moving average, you just master that along with other indicators, and that should work with you. And when you combine moving averages and other technical indicators with the theories and the practical aspects which I have discussed in previous sessions, then it will become a really powerful system for you to work upon. So now let's talk about a strong trend and weak trend. So if you are identifying a strong trend, so that means strong trend simply means that the price is above your moving average. So if that is there, then it is a strong trend. And if it keeps above that moving average, then it's a really strong uptrend. But sometimes what happens, it moves up, it moves down, it moves up, little bit down. Then if it is going that way, up and down, then it becomes a consolidation kind of pattern. If price remains always above the moving average or always below the moving average, then it is uptrend and downtrend respectively. You can understand the importance of moving average. So when market moves up, then definitely there are pullbacks. So if pullback is up to the moving average, then it's a strong trend. And if pullback goes below that moving average, then you should be concerned about market, and there is the chance that market has changed its structure and might be going down. So till now we have covered two aspects, that if price is above, it's uptrend, price is below, it's downtrend, and if price keeps on closing that moving average, then it's a consolidation zone. So now this aspect also covers you from the perspective, like we have discussed consolidation zones already during our previous sessions. So how to identify a consolidation zone? So that is also a criteria that moving average is frequently being cut upon by the price movement. So now the key aspect is which moving average you should be using. So if you're looking for the smaller moving average, maybe 5-day moving average, 10-day moving average, right, then your trading view should be for few sessions, so it can work for your swing trading. Now if you want longer kind of trading setup where you are actually investing, not trading for a couple of weeks or 4 weeks, if you are investing for 6 months, 1 year or 3 years, then your longer term moving average makes more sense. So longer term, when we say, so it could be 50, 100 and 200 day moving averages. If you are a day trader, then you can just use moving averages for 15-minute chart or maximum 30 minutes chart, or on the lower point of time you can use 5 minutes, 6 minutes or even 3 minutes people can use. So based on your horizon of the trading, based on your horizon of the investment, then you decide upon which moving average you are going to work upon. Are you in the stock markets but still guessing your next move? I am from Uncover Markets, and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. And there is one very important aspect about moving averages. So when a smaller moving average, so suppose this is a 50-day moving average. Suppose you create a chart for 20-day moving average and it comes like this. This is 20-day moving average. So where this 20-day moving average cuts the 50-day moving average, it provides you a very big signal. We called it as a crossover. Okay, we called it as crossover. So here what is happening? 20-day moving average is cutting the market 50-day moving average at this point. So this will be a bullish signal. So I have not drawn here, but you can see if a 20-day moving average is coming, it will cut it like this one. So this is 20-day and this is 50-day, and here a crossover is happening, and after that you can see it will go into a bullish direction. Similarly, if a 20-day moving average cuts this 50-day moving average towards downside, then you can expect that there is a higher chances of market going down. It's as simple as that. So that's it from moving average perspective. Now we are going to talk about RSI. So what is RSI? So RSI is something which does not tell you where to buy or sell. It reflects the strength and condition of the price movement, and if you interpret it correctly, it reveals the momentum. So RSI basically talks about your momentum. So what do? You want to identify a momentum in the market, whether it is upward momentum or whether it is downward momentum. In both the ways, RSI can help you out. So if we talk about RSI, it provides primarily two kind of signals. It provides you overbought signal and it provides you oversold signal. So if in general parlance, what we say, if RSI is above 70, then generally it provides the signal that it is overbought, and if RSI is less than 30, then it provides you the signal that it is oversold. Oversold means that a lot of people have sold it. Now there is a good chance that it will bounce back. When it is overbought, then simply means that a lot of people have already bought it, but now there could be the chance that it may go down. So you can see this signal here, it is kind of oversold, and after that market has actually moved up. Here you can see it is signal of overbought, and after that market just is not being bought. If market was still being bought, then it would have gone up, But now when the overbought signal has come, people have stopped buying. They are just maintaining here, and somewhere down the line it has started moving down, right? And after that you can see that there are different kind of signals. Again here we are getting, again here we are getting, and after that you can see it is again going up, it is again going up. So that's how RSI works. So there are some advanced concepts regarding RSI also, and how to use it more precisely, so that we are going to cover in our premium session. So basically, if you understand what RSI is saying, that RSI is a relative strength indicator, which tells you the strength relative in which tells you the strength of the move with respect to the recent move. So it is relative to each other. So here this move is coming very fast, so RSI is quickly moving up, and here the move was coming fast on the downside, so it was coming quickly down. So that's how RSI is interpreted. It does not measure anything from momentum perspective, but it provides you an indicator, an indication that momentum is there in the market or momentum is not in the market. Are you in the stock markets but still guessing your next move? I am from Uncover Markets, and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So generally, if market says that RSI is your around 50 to 60, then this is a good time to enter into the market if your other indicators and other setup of the market is going fine. But if other setup of the market is not providing you a comfort in the market, then RSI is of no use. So basically what you need to do, you need to see whether our previous conditions which we have discussed in previous sessions have been fulfilled or not. If those have not been fulfilled, anyways RSI you should not be watching, because you have already made the decision that those conditions are not fulfilled, so you are not going to take trade. But if those conditions fulfill themselves, then you look at the RSI and see where is the momentum. If there is momentum in the market, you go into it and take the trade. So that's how RSI is additional filtering criteria for you to make your overall trade process, investment process more robust. Now there is a very important aspect. So for over a period of time, RSI can stay very high because the overall trend is very high and momentum is high. So look at this trend. So in this trend, RSI is continuously near to 70, and here also if you look at here, it is constantly above 70, and in this period of time there was a huge momentum. Here also it was a huge momentum. So RSI was constantly, it touched, went back, again touched, so quickly it is touching. So over an extended period of time, RSI has a tendency to just quickly move to 60 to 70 range if overall trend is very high on the upside. So this is for your helping out in decision making when you have got all of your other parameters fulfilled for the trade. All other indications are saying that you should buy. RSI should be used as a filtering criteria to enter the trade. So that's it for the RSI. Now let's move on to the MACD. Now let's talk about MACD. So this is a very interesting indicator which we will talk about in little bit of details. So MACD, what does it tell you first? MACD, it does not tell you where to enter. A lot of people make that mistake that they enter into the trade by just looking at MACD. You should never do that. It tells you when the momentum is changing. It doesn't tell you where to enter into the trade, but it tells you where the momentum is shifting from low to high or high to low. How is it done? So let's see that. So first of all, what an MACD is having. So MACD looks very simple. So here is the MACD. There are couple of lines there. If you look at MACD, what it tells you. So now, first of all, let's look at what MACD is made of. So MACD is having two lines. One is the fast line and then the slower line. So generally what we do, we use fast line for the 12 moving averages, 12-day moving average, and slower line will be having a 26-day moving average. So if you look at the visibility here, we are talking about MACD line and signal line. So what is that signal line? Signal line we are talking about here is this orange line, and this MACD line is your blue line. Okay, so MACD line is blue line, and you can see this is the faster line. Faster line means 12 moving average. So this is your MACD line line, and this one is your signal line. What is a crossover? So when this MACD line crosses this signal line, it is a crossover. When these lines are crossing, this is a simply crossover. Now what does it tell us? So now before we talk about what does it tell us, are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. Let's talk about what most traders do. A lot of traders, what do? They see there is a crossover and then they enter into the trade, whether on the short side or whether on the long side. They see the crossover, they enter in the trade and then they burn their fingers. Similarly, somebody will enter into here and then at this point of time, possibly he may burn his fingers because these signals are frequent. Here again, this signal is coming. So if you are just taking the trade too frequently, it will actually make losses for you in terms of brokerage lost by frequent trading. And also if there are so many signals, so see there are so many signals. Here is a signal, here is a signal. So if you treat every crossover as a signal, then you will just keep on trading. A lot of trading you will be doing and a lot of brokerage you will be investing. So now what is MACD actually? MACD stands for moving average, convergence and divergence, which simply means we talked about this as 12-day moving average and this is 26-day moving average. So these moving averages are converging or these moving averages are diverging. It is simple. MACD, moving average, convergence or divergence. Convergence simply means price is converging towards each other. Divergence simply means price is going away from each other. So these moving averages are converging and diverging. That's why this is called as MACD. It measures the relationship between these two moving averages. Okay. So now we have seen these are what is this line? MACD line, what is this line? Signal line. Another third aspect is the histogram. Histogram is very important aspect and we will understand how it works and what does it mean. So three aspects we have now discussed about MACD. MACD line, signal line, and this is a faster line, this is a slower line which is a signal line, and this is a histogram. Okay, so what does this histogram shows us? Histogram shows us the distance between this faster line and the slower line. Faster line, when I say, that means I am talking about MACD. Slower line I am saying that is for signal line. So this moving average, there is a difference between the moving average, right? And this is captured by the histogram. So this line says that this is the difference. And you see when these converge, then histogram becomes 0. Here also it converges, it becomes 0. And when do we have this green histogram? Because MACD line is above signal line. And when it is red, when MACD line is below signal line. So then it's a negative difference. So that's how the histogram is created. Now we have talked about MACD. Now let's discuss what does this 0 means. When the crossover happens, what does that mean? So it simply means that momentum could be shifting. So when our MACD crossover happens here, then you can think that okay, there is a chance that now the crossover has happened, so momentum could be shifting. Now you look at this point of time. Here, first indication is that momentum is shifting because crossover has happened and it is at somewhere this point of time. So there is a chance, see, this has been a big up move. And after that, here is the first indication that there is the chance of momentum being shifted. It has not shifted yet, but there is a chance that it could be shifting. It is again going up, but now it has not gone up too much. So initially it was a really big move, but after that, first sign of momentum shifting has come, and after that it has just gone a little bit up, and after that it has gone down. See here the momentum has completely shifted and it is going down. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So it is just like, if you understand, you are driving a car at 150 miles per hour, and after that you have to shift it, you have to slow it down. So there is a chance that possibly you are looking at the destination, and then there is a chance that you will first put some brakes. So in the first brakes, your MACD is going to see the crossover. You might not be stopping. You might see that, okay, your destination has not come. So still, once you take the brakes here, after that you again go up a little bit, and after that you finally stop. So it's just like, there is a high momentum, it will just slow down, and after that it will halt, and after that it will go on the downside. So exactly that's how MACD works. So this is a critical insight which you must have in your mind, that MACD does not mean that when a crossover happens then you should enter or you should exit. That it does not mean that. It simply means that you should be now careful that momentum might be shifting, and once it shifts based on other parameters, you just enter or exit the market. Now the thing is, why the crossovers are not taken as first litmus test for your entry and exit. That happens because when there is a good uptrend, then from time to time, look at this point of time, there will be some pullbacks. So people who had entered in the trade here, market went to this point, after that they booked some profit for them. Definitely it is going to happen. Some people are going to book profit, and then market will see a jerky reaction, and at that point of time also your MACD will see a crossover. But it is not enough. So that's where only MACD and its crossovers are not going to indicate whether you should enter into the trade or exit from the trade. You need to be careful about other factors as well, which we have already discussed. Now, one very important aspect is, look at these bars. These are the shifting bars. That means these are the higher bars. So here bar is smaller than higher, higher, higher. That means momentum is higher. Your lower moving average is having more momentum than the higher moving average, and that means a momentum is very strong. And when it starts to go down, that simply means that momentum is now reducing in the market. Now you can take a call whether to stay in the market or whether to come out of the market. So that's your call you have to take. So now the key action for you, look at multiple charts, look at the moving average, look at the MACD, and then RSI. How these three indicators are working at different time frames and at different locations in the chart. And you also see, based on the concepts which I have just told you, whether you are able to identify whether the market is going to go up or whether it is going to go down. So that's it from this session, and we will see a lot of other sessions where we are going to see the practical aspects of these sessions and these concepts, and those will be our premium sessions. You can subscribe to our channel and we will enable the access of those premium content for you. Thank you.